In this video, we're going to discuss exchange rates and the balance of payments. So, foreign exchange and foreign currency is the money that we need to buy goods and services that are produced in another country. If we want to buy goods and services produced somewhere else, we have to be able to get the currency from that country in order to complete the transaction. Foreign exchange, or currencies of all the different countries, are traded in a foreign exchange market. And in these markets, the currency of one country can be exchanged for the currency of another country. Now, the exchange rate is the price that one currency is exchanged for another currency. An exchange rate is a price. Now, when the fall in the value of when one currency is falling in value relative to another currency, we call that currency depreciation. And when one currency is rising in terms of another currency, we call that currency appreciation. So an exchange rate is a price. It's the price of one currency in terms of another. And these prices are determined in actively traded competitive markets. We call it the foreign exchange market. Any place where you can exchange one currency for another currency is part of the foreign exchange market. And for currencies like the U.S. dollar and the Japanese yen and the euro and the Chinese yuan, these are traded by many people every day. There's traders all around the world in markets monitoring and trading all of these currencies. So we look here, we can see this is a few months old. It's from December, but the United States dollar, the exchange rate is 6.55 Chinese yuan for $1. So if you wanted to buy a dollar, you'd need to supply 6.55 Chinese yuan, and if you wanted 6.55 Chinese yuan, you'd need $1. And so there's a reciprocal nature to foreign exchange, to currencies being traded. We say that the demand for one money is the supply of another money. When somebody in Japan wants US dollars, maybe they want to buy goods from the United States, well, they demand US dollars and they have to pay for them or by supplying Japanese yen. So we can see here another example between the euro and the dollar. The demand for one currency is the supply of the other. Back in December, one US dollar was equal to 0.82 euros, which is the same thing as saying 1 euro is equal to 1.1 United States dollars. So there's this reciprocal nature between the two currencies. The exchange rate is the price of one currency in exchanging for another currency, and the demand for one currency is the supply of another currency. So let's look at the demand for a currency in a foreign exchange market. And the demand is really the quantity of dollars that traders and people plan to buy in a given period of time. And it depends on a number of factors. It depends on the exchange rate, which is the price. Demand always depends on the price. Because of the law of demand, the higher the price, the higher exchange rate, the less is demanded. And the lower the exchange rate, the more is demanded. Well, demand for currencies also depends upon the demand for a country's exports. If the demand for a country's exports are high, then the demand for their currency will be high because people will need to get the currency in order to pay for the exports. If interest rates in a particular country are high, the demand for that currency will be high because people will want to transfer money into that currency so they can make investments that earn the higher interest rates. And if people expect in the future for the exchange rate to improve or go up, then they're going to want to um, have a higher demand for that currency now because you demand it now, and then when the exchange rate goes up, you've made a gain or profit. So all of these factors can affect the demand for a currency. Now, the law of demand applies to currency, but the demand for currencies is derived demand. We don't necessarily demand the currency in and of itself. We demand the products, the goods and services that the currency enables us to buy. So people buy US dollars so they can buy US produced goods and services or US assets. So if people want to travel to the United States or buy Levi's jeans or drink Budweiser beer, all things produced in the United States, well, then they have to have dollars in order to do that. So we call this derived demand. You're demanding the currency not for the currency for the sake of owning the currency, but for the sake of being able to buy the things that the currency allows you to buy. Now, the demand is heavily influenced, or the exchange rate and the demand for currency is heavily influenced by the demand for a country's exports. So the more people want blue crabs from Maryland and Marvel movies made in California and Ford trucks made in euphemistically in Detroit, um, and the larger they value these things around the world, then the greater is the quantity of U.S. dollars demanded. People need more dollars to buy these things, and the interest is greater, and so the value of the U.S. exports is one of the things that determines demand. And then lastly, the expected profit. If I'm expecting to be able to make a profit by holding dollars, either because I can put it in a bank with higher interest rates or because I believe the currency will appreciate, and by holding the dollars, I'll be able to make a profit, then the demand um, will increase now. So all of these things affect the demand for a currency. And uh, when you look at the demand curve for a currency, it's like any other demand curve. It's downward sloping. The higher the price, in this case, the exchange rate, the less is demanded. The lower the price, the lower the exchange rate, the more is demanded. So the demand curve for dollars in this case, or any currency, is always going to be downward sloping. Now let's look at supply. Supply of a currency depends upon the price or the exchange rate, but it also depends upon, um, if we're looking at supply of US dollars, well, the demand for imports into the United States and the relative, the interest rates relative to what is being, um, uh, 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 what interest rates are in other countries in other currencies, and of course the expected future exchange rate. So if um, if the exchange rate is higher, then the greater the quantity of U.S. dollars supplied in foreign exchange markets. There are one of the reasons is the import effect. So the larger is the value of U.S. imports, well, the larger is the quantity of dollars that we have to supply to get the other currency to pay for those imports. And so, if to the extent that we like German cars and French champagne and Swiss watches, the greater is our interest in those, and the greater the value that we place on those, well, then the more dollars we have to supply to get the um, the, um, um, the foreign currency in order to pay for them to meet that interest, or demand for imports. Now, it's always the case that um, demand and supply will both be affected by expected future profits, but certainly supply in this case will be will be affected. So to the extent that people feel that, um, if they feel an exchange rate is going to depreciate, the price is going to go down, well, they'll supply more of the currency today, in the hopes that they'll be able to sell it at the higher price today, and then when it goes down, they'll be able to either buy it back or make a profit. So expectations about future profit will determine and influence the amount of supply of a particular currency. And so the supply for a currency is an upward sloping supply curve. It's the law of supply. The higher the price or in this case exchange rate, the more of a currency that's supplied, the lower the price, the exchange rate, the less is supplied. And so the supply curve is upward sloping like all supply curves. And then if we put the demand for a currency and the supply for a currency together, um, we can there's some point where the demand and supply curve will cross. That's the equilibrium. In that case, you have some sort of a balance between the supply for currency and demand for currency, and the price that's associated with that equilibrium is the exchange rate, and the quantity associated with that equilibrium is is the quantity that gets traded in the foreign exchange market. When a situation arises that the exchange rate is too high, there's a surplus of a currency, and that surplus will drive the price, the exchange rate down. If it's too low, the opposite happens. There's a shortage, and the competition to get the currency drives the price up. And so, in general, we either at an equilibrium in a currency market, or we are out of equilibrium, but the the flexibility of prices, the ability for the price to adjust. In this case, the price is the exchange rate to adjust, brings us either at back to equilibrium or has us being tended towards equilibrium. Now, just like any market with supply and demand, you can have changes to demand. You can have changes to supply, and so if if the price or the exchange rate changes, well, then we'll move to a different point on the demand or supply curve, and we'll have a new equilibrium. But the curves themselves don't change. But if you have changes to things that affect supply and demand other than the exchange rate, other than the price, such as the world demand for our U.S. exports, the relative positions of interest rates in the United States versus other country, or changes to expected future profits that are related to currencies, well, then you can have a change in demand or supply itself, and the whole curve can shift. So if the worldwide interest in U.S. products, in products that would be exported from the U.S. increases, if there's more interest in fly fishing gear from LL Bean, or wine from California, or beef from Texas, well, that will cause a change in demand for a currency. If the opposite were to happen, if there was less interest, then demand would decline. It's also true that interest rates can change. The United States interest rates, the differential between the interest rates in the United States and interest rates in other countries, if the interest rates in the U.S. increase and they stay the same somewhere else, then the demand curve for U.S. currency will increase. People will want to exchange their currencies for U.S. currency so they can deposit it or make loans with U.S. Banks and earn higher uh, um, profits as a result. So, if that opportunity exists because of higher interest rates in the United States, then there'll be more demand for United States currency. And the opposite is also true. If the interest rates go down in the U.S. vis-a-vis other countries, or the rates go up somewhere else, then the demand for the U.S. currency will go down as a byproduct or result of that. And then there's always a situation with the expectations about future exchange rates. If that changes, if people are expecting the United States currency to appreciate, then they're going to demand more now. If they're expecting it to to depreciate in the future, they're going to demand less U.S. currency now. So all of these things can wind up affecting the demand for a currency, and if in these cases, you're not going to have a movement along the curve, but an actual shift in the curve in total. When you have a greater greater interest in U.S. exports, or greater differential interest rates, or greater expectations about the future of the U.S. currency, then the demand will shift out to the right. And if any of those things are declining, or they're all declining, then you'll have a shift to the left with less demand. And so this is no different than normal supply and demand and shifts in the curves. It, in the international context, it takes on, there's some different dynamics, but the principles behind it are essentially the same. Now, we can also have a change in supply. If there is a change in the exchange rate or the price of a currency, well, then supply won't change. We'll just move from one point on the supply curve to another point in the curve. But if you have a change of something that affects supply that's not related to the exchange rate or price, then you will have a shift in supply. This happens when the demand for imports into the United States increases. The United States interest rates become lower relative to interest rates in other countries, or people are expecting depreciation of the United States currency, and therefore their expectations about the future exchange rates are lower, and so the they're gonna act now, and supply will decline. So imports is one of the major factors that drives the supply. Our demand for imports, or our interest in imports, is one of the major factors that drives the supply of the U.S. currency. So if we have a greater interest and therefore want to import, TVs from Japan and cars from England, although I think it's now Germany, and watches from Switzerland, then we're going to have to supply more dollars now. If our interest level in these products or products from other places increases, then our supply of our currency will also increase as a byproduct. The same is true with interest rates. If interest rates are increasing somewhere else and decreasing here, then the supply of U.S. currency is going to be greater. People are going to want to take advantage of increased interest rates outside the United States. They're going to supply U.S. dollars to get the currency where the interest rates are higher. And in that process, they're going to supply more of the U.S. currency as a result. And the same is true if they're expecting the U.S. dollar to depreciate. They're going to supply more dollars now with an interest or effort to try to make money in profit in the future after the depreciation happens. So any one of these changes can result in there being an increase in supply, a shift of the whole curve to the right, or a decrease in supply, a shift of the whole curve to the left. And so these are the dynamics of the market for currencies, for the market for um, uh, the various currencies around the world. And these same dynamics affect all of the currencies that are used and traded and exchanged around the world. So, in general, when the demand for U.S. dollars increases, well, then the price is going to go up. The exchange rate is going to go up. If the demand for dollars decreases and, of course, supply doesn't change, ceteris paribus, then the price or exchange rate will fall. When the supply of dollars increases and demand stays the same, the exchange rate, the price falls. And when the supply of dollars decreases and the demand doesn't change, then the exchange rate rises, the price rises. And so, again, this is not any different than any market. Some of the terminology is different. Instead of calling it a price, we call it an exchange rate, but an exchange rate is a price. And so when demand increases or supply decreases, we expect to see higher prices, higher exchange rates. When demand decreases or supply increases, those are forces that result in lower prices and lower exchange rates. Now, the foreign exchange markets, there are anybody who is involved in the trading of one currency for another is really part of the foreign exchange markets. But there are businesses and traders who actively monitor and trade these currencies. These markets are very efficient. They're efficient because there's a lot of volume that gets traded. There's a lot of liquidity for all of these currencies. So these are very active, highly traded markets, and they're efficient as a result. And so what that means is that any expectations, um, any changes that happen in the underlying data that would affect a currency that would affect supply or demand are very quickly acted upon. They're very quickly incorporated into market prices. Part of the reason is because of interest rate parity, meaning, a currency's part of what a currency is valued on is based on what it can earn. And the return to a currency, one of the returns to a currency is the interest rate. So if interest rates go up in the United States relative to other countries, then the demand for the United States currency will go up and the price of the currency will go up. And this happens in any other efficient market or highly traded market. It happens quickly, and we know that it will balance things out. So the interest rates that people earn after you make accommodations for changes in exchange rates are basically on par or in parity. What happens if they're not on par and parity? Well, then people will move money around from one place to another, and they'll drive the exchange rates up and down until in effect they wind up becoming in in line with each other or in parity. Now, it's also true that there's a set of forces or a tendency towards purchasing power parity. This is the amount that a currency can purchase. If that becomes out of balance between after you account for exchange rates between different countries, then people will move money from one currency to another currency and buy goods and services in the currency where it's out of balance. And that process is like any process. We have more demand, the price will go up, and it'll eventually become back into balance. So the both because of interest rate parity and purchasing power parity, the market for currencies, the prices, the exchange rates, the prices that are used for trading different currencies is very efficient. It winds up incorporating all the available information. It does it quickly, and the prices the prices we wind up being tending towards equilibrium very quickly in these markets. Uh, and this is because any information about exchange rates is very quickly incorporated. Any new data we have is immediately incorporated. Let's suppose the Bank of Japan is considering raising interest rates next week. It's announced on a Monday morning in the news. Almost instantly, currency traders will demand more yen, uh, uh, um, and they'll demand less dollars, and they'll just do this, very actively until the new prices, the new exchange rates reflect the opportunities that are in existence and reflect all of the data and all of the knowledge that's available in the marketplace. Said another way, that these fluctuations happen instantaneously, again because it's a actively traded market, and so the prices that we see in the marketplace um, are, uh, are 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 accurate and reflect all of the known market information. The fact there are so many people trading these currencies, uh, and the news is acted upon right away, makes these markets efficient markets. So the prices that we see um, in in foreign exchange are 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 believed to reflect all of the known information and data and all of the incentives and expectations that are available in the marketplace. Now, there's something called the real exchange rate, which tries to look um, at the amount of goods and services that can be purchased in different countries. So in this case, we try to the real exchange rate tries to look at both the exchange rate and the prices or the price levels in the two countries as a way of trying to see how much of one country's GDP can be purchased with another country's currency. It's trying to take some of the monetary aspects out of the exchange rate, if that's possible, and look at the underlying um, uh, uh, ability, the underlying purchasing power of the currencies. And so we know that in the long run, the real exchange rate is determined by the real forces of supply and demand in the markets for goods and services. So when we see this gets back to the idea that the demand and supply for currency is derived demand and supply, meaning that people don't demand and supply the currency for the currency itself. They demand the currencies so they can buy and sell the goods that having the currency makes possible. And so in the long run, if we look at the real exchange rate, we factor out some of the monetary or money aspects of this, we wind up arriving at at the exchange rates between the currencies reflecting the real forces of supply and demand in the markets for the goods and services. Now let's look at exchange rate policy. So one of the ways or one of the policies that you can have towards exchange rates is to have a flexible exchange rate policy, meaning let the market figure out what the relative exchange rates are. We know the market is efficient. It incorporates all the various demand and supply, all the all the information, all the underlying factors about the relative productivities of the economy, and in this case, we let the market determine the exchange rates. It's determined by supply and demand without any intervention by a foreign government or a central bank. An alternative to that is to have a fixed exchange rate. In this case, you have a desired exchange rate you'd like to achieve. And then if the market brings the exchange rate away from the target that you desire, then you use a market intervention, buying and selling foreign exchange in order to block the forces of supply and demand. And so a fixed exchange rate requires an active intervention in the market for foreign exchange. So sometimes countries, when their currency is being devalued, will want to step in and try to have a higher exchange rate because there's a certain they're trying to instill confidence in the currency of their country. Well, they'll go in and they'll buy currency as it's depreciating as a way of trying to delay depreciation. Another way that reason you might do this is maybe you have a target. You want to have a certain exchange rate to make your um, you might want to have your currency actually be lower than where the market is trying to take it. Why would you do that? Well, if you want to export a lot of goods and services to other countries, you want your products to appear low in price to consumers in other countries. And so by having a lower exchange rate, lower than the market will be able to generate, well then you're gonna your exports will seem inexpensive to other folks. So it's another way of 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 supporting producers and exporters and production in your country. And so instead of supporting specific producers, you're kind of supporting producers overall because all exports to other countries will seem inexpensive from the perspective of other countries. And so again, in any of these cases, the central bank has to intervene in the foreign exchange market to keep the exchange rate as close to the target rate. Um, and you might, if the rate, if you wanted the rate um, to go down, you might sell into that market. If you wanted the rate to go up, you would provide demand. You would buy the currency in that market. But in either case, it requires an active intervention. And um, one of the issues with this is that you're fighting the market. you're fighting the forces, the underlying forces that of supply and demand and all these forces. So it's hard to intervene in a market over a long term on one side. If you want to keep your currency up and the market's trying to take it down, it's hard to maintain the amount of buying you're going to have to do in order to keep that exchange rate higher. The same thing is true when you're trying to keep an exchange rate lower. It's if the market is valuing the currency higher and you want it to be lower, you're going to have to sell a lot into that market in order to keep um, the exchange rate lower. So these types of interventions are hard to maintain over the longer term. They're not easy to sustain if they're always on one side. Now, a third policy for exchange rates is something called the crawling peg. Understanding it's hard to keep supporting something in one direction. Well, you can have a target that you're trying to maintain with intervention, but if the target becomes harder and harder to maintain over time, well, you can move the target. The target can become like a crawling peg. It works like a fixed exchange rate in the short term, but you move it over time. And um, this is something that China has been doing recently. They want to have their exchange rate be low for their currency because by having an exchange rate that's low, it makes products that are produced in China less expensive to consumers around the world. And so the demand for Chinese made products is high in that circumstance. But if you're doing this over a longer period of time, it becomes difficult and sustainable. So you can, by moving the target slowly, you can achieve some of the effects of having a fixed exchange rate policy without uh, uh, with with recognizing the fact that you're going to have to also um, uh, pay attention to the market and the market forces at the same time. Now, sometimes when countries um, intervene to try to achieve a certain result with the currency, it's considered currency manipulation, which you can see here. This is a press report from 2020 where the United States said that Switzerland and Vietnam were taking actions where they're considered a currency manipulator. It doesn't. Um, it, it it it's just trying to uh, 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 it's trying to encourage countries to let the market determine the the exchange rates, the prices on which the currencies are exchanged. And of course, some countries need to go in and do things but if you're acting too much in the marketplace, if you're intervening too much in the marketplace, um, you might be labeled a currency manipulator and trying what they're trying to do in that case is um, maybe shame or pressure you into letting the free market determine the exchange rates rather than too much currency intervention. Okay, let's talk about the balance of payments. Well, the balance of payments is like an account that records all of the movements of money between countries. So this records all of the money that's exchanged for international trading, but it also includes the monies that are exchanged for borrowing and lending. We can see that the net exports, which is the exports minus the imports, is the chart here is for the United States. In 2020, it was a negative $617 billion, meaning the United States imported 617 billion dollars more than they exported. And this has been something that's been going on for a number of years in the United States, importing more than exporting. Um, there are other things that go into the current account and into the trade balance, but the main the main one is the net exports, the exports minus the imports negative 617 billion for 2020 um, for the United States. And we can see here, if we look at some of the data underneath, that um, a large part of the the imbalance is on goods, where the importation we're importing way more goods than we're exporting, and we're actually exporting more services than we're importing, consistent with the idea that U.S. A big part of the GDP in the United States is services oriented, producing services as opposed to goods. Now, if we look specifically at international borrowing and lending, we can look at a country that, if a country borrows more from the rest of the world in a given year than it lends, it's a net borrower. The United States has been a net borrower since the early 1980s, meaning the United States has borrowed more from the rest of the world than it's lent since the early 1980s. This is due to the fact that the United States government has been running deficits, um, a half a trillion now, regularly 1 trillion, and in the last few years, $2 or $3 trillion per year. The United States debt at the end of 2020 was $28 trillion, and so where does that money come from? Some of that money comes from within in the United States, but some of that money is borrowed from other countries. The biggest holders of United States debt, United States government debt, is Japan, China, England, and Ireland. And so since the early 1980s, the United States has been a net borrower, borrowing more from other people than we're lending. Now, that's not a problem necessarily. If you're using the borrowed funds to finance capital accumulation to build future productive capacity that will increase production and incomes in the future, maybe that's okay. But if you're using it to finance consumption, um, then that's probably not okay. So um, it gets back to the age old question about the borrowing is an issue, but also what are you using the borrowing for? If you're using the borrowing to invest in future productive capacity, then you'll have the ability to grow your economy and grow your incomes and probably pay whatever money you're borrowing back. If you're using it for consumption, then the opposite is true. Now, when we're looking at um, being a net borrower, a net lender, that's in a particular year. But if we look over time, a debtor nation is a nation that has borrowed more from the rest of the world than it's loaned to the rest of the world. And since 1986, um, since the time that Ronald Reagan was president and the Mets, of all people, won a World Series, and the first Back to the Future movie was out, and Van Halen had the #1 LP. I don't even believe it was a CD at that point. Maybe it was. Since 1986, the United States has been a debtor nation. And again, this gets back to the fact the United States has been, as the United States government has been, running deficits. Each year, the deficits are getting larger and larger, and they've been borrowing money, issuing treasury bills, some of which are some of those treasury bills are purchased. Some of those loans are made by people within the United States, and some of those, a large portion of those, are also being purchased. A large portion of these loans are being made by governments and people outside of the United States.